Good day, students. Welcome back to Accounting 2401, Principles of Financial Accounting. This is Dr. Mercado speaking. And in this particular lecture, we are going to be covering problem 12-3A. We continue covering Chapter 12, which deals with corporations. We have information about the organization, stock transactions, and dividends. Okay, so let's jump over to the problem. Okay, it's a kind of a long problem. Okay, so it says selected stock transactions. The following selected accounts appear in the ledger of Parks Construction Inc. at the beginning of the current year. We've got preferred 2% stock at $100 par value. We've got 100,000 shares authorized, 80,000 shares issued. We've got in our books $8 million for preferred stock. Paid-in capital in excess of par for preferred stock, $440,000. Common stock at $5 a par. We've got 5 million shares authorized and 4 million shares have been issued. We have it in our books for $20 million. We've got paid-in capital in excess of par for common stock, $2,280,000. And we've got retained earnings of $115,400,000. During the year, the corporation completed a number of transactions affecting the stockholders' equity. They are summarized as follows, and we have letters A through G. Okay. Instructions: we have to journalize the entries to record the transactions. Okay. So let's start with letter A. Okay. Let me just go ahead and format this Arial 16. Okay. Okay, so we're going to start off with letter A. It says we issued 220,000 shares of common stock at $14, receiving cash. So we receive cash. We are issuing common stock. Now let's look at our common stock. Our common stock has a par value of $5. Okay, so in our books, the par value is $5 for common stock. We sold it for $14. That's major premium. Okay, so when we issue stock, what do we receive? We receive cash. Okay, how much cash did I receive? Well, we issued 220,000 shares of stock at $14 a share. Okay, so how much is that? We've got 220 times $14. That's $3,080,000. So that is how much cash we received in exchange for those 220,000 shares of stock. Okay, so we received $3,080,000. Okay, then we have to journalize the actual entry to our common stock. Okay, so we can identify how many additional shares of common stock have been issued. So here we have common stock issued of 220,000 shares. And remember, we always record the entry to our common stock at par. My par value is $5. Okay. So we've got 220 times 5. That gives me 1,100,000. Okay. Okay. And of course, we know that these people paid a premium for this stock because our par value is 5. They paid $14 for each stock. Okay, each share of stock. So we're going to have paid-in capital in excess of par. This is for common stock. And then we have the 220,000 shares. Okay. Times, and then we've got, they paid $14 minus the par value of $5. Okay. Okay. So, the stocks were issued at $14 when the par value was $5, so that's a $9 premium. And we're going to multiply that $9 premium times the number of shares. That's 220. So that means that my paid-in capital is $1,980,000. Okay. That is transaction A. Okay. So in this case, we issued shares of common stock at a premium. Okay. In letter B, we issued 12,000 shares of preferred 2% stock at $110. So in this scenario, we are issuing preferred stock. Okay, remember, we have to keep them or keep track of them differently. Different accounts. So for letter B, okay, what did we receive? We received cash. Okay, how many shares were issued? We had 12,000 shares issued at $110 a share. Okay, so that's going to give me 12,000 times 110. That's going to give me 1,320,000. That is how much cash was received. Okay. Now we know that we have to record our preferred stock at par. Okay, so we have 12,000 shares, and my preferred stock is at $100 par value. Okay, so then that's going to give me 12,000 times $100 par value. That's going to give me 1,200,000. Okay. Now, we know that we had 12,000 shares of stock issued at $110, yet my par value for my preferred stock is $100. So they paid a premium of $10 per share. Okay, that premium is going to go into my paid-in capital in excess of par, and this is for my preferred stock. Okay, and we have 12,000 shares. Okay, times, and then we have they paid $110 minus my par of 100. Okay. So now I can do my calculation. So they paid 110 when my par is 100. So that's a premium of $10 per share. And I'm going to multiply that by 12,000 shares. That's going to give me a paid in excess of par of $120,000. Remember, debits must always equal credits. In letter C, we purchased, okay? In letter A and B, we issued out shares. If you read through the chapter, we do have the option of purchasing back some of those shares, okay? So in transaction C, we purchased 160 shares of Treasury Common for $10 per share, okay? So we purchased 160,000 shares of Treasury Common back, okay? So what did we obtain? Well, we bought some Treasury stock. We got 160,000 shares at $10 a share. Okay. So 160,000 times $10, that's $1.6 million. Okay. And we purchased this treasury stock for cash. Okay, so what had happened? We bought the stock back, so we gave them cash. They gave us treasury stock. So my cash is going to decrease by the 1,600,000. Okay, so we purchased treasury stock. So my cash is going to go down. It's going to decrease, and now I have more treasury stock in my books. Okay, that is transaction C. Okay, transaction D. We sold 105,000 shares of Treasury Common for $16 per share. So remember that in transaction C, we bought those Treasury Common for $10. Now we sold 105,000 of those shares for a higher price, for $16. So we're selling those Treasury Common at a premium. Okay. So what did we receive? When we make a sale of stock, we receive cash. Okay. How much cash did we get? Well, we sold 105,000 shares and at $16 a share. And let's see what we get. 105 times 16, that gives me 1,680,000. Okay. So we went ahead and we, in letter D, we sold 105,000 shares of Treasury Common. Now we have to update our Treasury stock. Okay. We sold 105,000 shares, and the par value of those shares were $10. Okay. So we're gonna have 105,000 times $10. That's gonna give me 1,050,000. Okay. And now we have, if you recall, we paid $10 for them. Now we're selling it for 16. So we're selling them at a premium. Okay. So we have paid in capital from sale of treasury stock. Okay. 105,000 shares times 16 minus $10. Okay, so I know that I paid $10, that's my par value, and I'm selling it for 16. So I've got a premium of $6. $6 times 105,000 shares, that's going to give me a premium of $630,000. Okay. That is transaction D. Okay, we are selling 105,000 shares of the treasury common stock we had purchased earlier. Okay. In letter E, we sold 40,000 shares of treasury common for $8 a share. Now be very careful. We paid $10 for these shares. Now we're selling 40,000 shares for less, for $8. So we're selling them at a discount. Okay. So this is going to be a little bit different. Okay. So we sold shares. What do we get when we sell shares? We receive cash. Okay. How much cash do we get? Well, we sold 40,000 shares at $8 a share. 40,000 times 8, we received $320,000 of cash. Okay. So our share was valued at $10 a piece. We sold it for $8, so we sold it for $2 less than par value. Okay. Okay, so now we're going to offset that entry for that discount to my paid in capital from sale of treasury stock. And that's going to be 40,000 shares times $10 minus 8. Okay. And then that's going to give me, okay, so it was valued at 10. I paid 8. So I have a discount of $2 times 40,000. Oh, sorry about that. So I've got 10 minus 8. That's a $2 discount times 40,000 shares. That's going to give me a discount of $80,000. Now this is going to be on the debit side because this is kind of like a loss. Okay, we're selling it for less than what our stock is worth. Okay, we're selling it for $8 when our par value is $10. Okay, so if you have a discount, your paid in capital account is going to be debited. If you're selling at a premium, your paid in capital from the sale of the account is going to be a credit. Okay. And then we're going to record our entry to treasury stock to record the actual sale of those stock. And we have treasury stock. We sold 40,000 shares at $10 a piece. Okay. We always have to record our entry to our stock at par value. Even though we sold it for $8, we have to record our stock, our treasury stock entry for the premium. For the par value. Okay. So the entry to your treasury stock always has to be at par. And then if we sold at a discount, then our paid in capital will be a debit. If we sold at a premium, then our paid in capital is going to be a credit. Okay, so in this case, we've got treasury stock, 40,000 shares at $10 a piece. That's going to give us $400,000. Okay. That is letter E. Okay. Letter F. We declared cash dividends of $2 per share on preferred stock and 8 cents per share on common stock. Okay. We declared dividends. Okay. Okay. Now we have to do some math here because we need to figure out how much we have in each type of dividend and do our multiplication. So we declared dividends of $2 per share for preferred, 8 cents per common stock. So let's do our calculations down here. Okay. Let me move this up a little. Okay. Okay, so at the beginning of the year, let's go look up here. We've got preferred. We had 80,000 shares outstanding of preferred. Okay. So I'm going to put 80,000 shares of preferred. Okay. And for common, we had 4 million shares issued. Okay. And these are shares. Okay. Now in letter A, let's look at letter A. We had an entry to common stock for 1,100,000, and that was for 220,000, an issuance of 220,000 shares of stock. So we have 220,000 in letter A. Okay, and this is common stock. So we're going to put it under common stock. Okay. In letter B, we had preferred stock, 12,000 shares. Okay, so in letter B, we had 12,000 preferred. In letter C, we have treasury stock. And that treasury stock, we had 160,000. Now it says treasury common. So it's common stock. We're going to put those over in letter C. Okay, in letter C, we had, in this case, we purchased. We didn't issue, we purchased. So because we purchased back from the market, that will be a deduction, okay, of 160,000, okay. We basically removed that from outstanding shares, okay. So we bought them back. They are no longer outstanding, okay. So when we issue them, we aggregate it because remember, we can't exceed the number of authorized shares. Okay, we can only issue up to that amount. Okay, so if we buy some of our outstanding shares back, then that goes ahead and increases the amount of shares available to be sold. Okay, so remember the 160 is a negative because we purchased back some of that stock. Okay, in letter D, we had a treasury common stock that we sold. Okay, and we sold 105,000 shares. So we are once again selling in letter D. If it's a sell, it's going to be a positive number. We had 105,000. So remember, it's a positive number if we sell. It's a negative number if we buy back some of the stock. Okay. And letter, that was letter D. Letter E, we had treasury stock. That's common. And we sold 40,000 of it. Okay, so letter E, we sold 40,000 shares. Okay, so we're going to add the numbers to see what we get. Okay, let's see. So we're going to add our total for preferred, 92,000 shares. And then we're going to add our common stock. And that's going to give me 4,205,000 shares. Okay. Now the problem says that we're going to multiply it by $2 for my preferred. Okay. And we're going to multiply it by 0.08 cents for my common. Okay, and now we get our 92,000 shares times our $2. That's going to give me 184,000. Okay, shares for preferred, and then we're going to get our 4,205,000 times our 0.08 cents. And that's going to give me 336,400 of my common stock shares. Okay, so I've got 184,000 preferred, 336,400 common. Okay. Okay. Now, if we add those together, okay, what do we get? Okay, so we're going to go ahead and we have our 92,000 shares at $2 a piece. That's going to give me 184,000. And then I've got 4,205 shares of common stock at 0.8 cents. That's going to give me, okay, let's see, 4,205, 1, 2, 3 times 0.08, 336,400. So 336,400, okay, plus a 184, that's going to give me 520,400. If you have these two, the 184 and the 336, you add them together, that is going to give you the 520,400. 184 plus 336,400, 520,400. Okay? So, in letter F, it says that we are declaring the $2 per share of preferred and the 8 cents per share on common stock. So if we are declaring, I'm going to go ahead and I'm going to debit my cash dividends. And the total that we calculated for both, I'm going to put my total here. It's 520,400. Okay. And that is basically the sum of those two numbers for your preferred and your common. You add them together. And then that gives you your 520,400. Okay. So we're going to have cash dividends of 520,400 debit. Okay. And we're going to put that money into our cash dividend payable. Because we're not paying them out yet. We're just declaring. Okay. So I debited my cash dividends of 520,400 and I credited my cash dividends payable. And how did I get that 520,400? Well, we had to aggregate all of our outstanding shares of stock for preferred and common, get the total number of shares, and then multiply by the amounts provided here of how much they were declaring for your preferred or for their common stock. $2 for preferred, 8 cents per common. We multiply that and then we get the amount of the cash dividends. Okay, that is letter F. Okay, now in letter G, we're actually paying the cash dividends. Okay, so in letter G, we are actually making a payment for the cash dividends. If we look at letter F, the dividends had already been declared and the money had been set aside into your cash dividends payable. So now I'm going to take the money out of my cash dividends payable. Okay, I'm going to go ahead and I'm going to debit, take the money out of my payable of 520,400, and I'm actually going to pay out my stockholders with cash. Okay. So in letter F, we declared the dividends and we calculated how much we were going to declare based on the preferred or the common. And then once we do that, we put the money aside into our cash dividends payable account. Okay. And then in letter G, we're actually making a payment to our stockholders. So we take the money out of our payable and we credit cash. Okay. So those are all of the transactions A through G that we had to analyze and record. Okay. I just like to be on the safe side. I like to make sure that my debits equal my credits. So I'm just going to do a quick sum. That way I can figure out, you know what, does my debits equal my credits? Am I in balance or do I need to go back and review my work? But everything seems to be okay. Both my debit and credit column equal for 9,120,800. Okay. So this is problem 12-3. A lot of transactions that we have to analyze and record. Some of these had paid in capital in excess. We sold these shares of stock at a premium. We had one scenario where we sold at a discount. So we need to make sure that we analyze how much money are we receiving. Are we receiving more than par or less than par? If it's more, we're selling at a premium. If it's less, we're selling at a discount. Okay. Please make sure that you read, that you attempt all of your homework problems, that you review the Show Me How videos embedded in your homework. That way you can get a little bit more guidance. But do not expect to just watch the video and learn how to do the problem. Reading needs to happen. Please become familiar with the content. If you have any questions or concerns, please do not hesitate to contact me. That is it. Have a wonderful rest of your day, and until next time. Bye-bye.